Make a decision. Make a decision. What do you want to do? You want to go long or you want to go short?
I'll go long.
Me too. Why? Trend and the market's going up. Okay. Now, the question is should we go long this instant?
Right.
Or should we wait until it says 1101?
1101.
Because why? Because we buy near support. Right now it's resistance at 1100, isn't it?
Right.
So I want to see it go through the 1100, and then this line becomes support. And the general rule says buy near support. See, if you follow the general rules, people, I won't say you can't go wrong, but it's hard to go wrong. Okay? Everybody with me on that?
So this delay time is a real good indicator.
Well, and you're keying on the people waiting 15 minutes. Okay, why did they wait the 15 minutes? Is it because of the lead lag or because they were unsure of an up market? They're unsure of an up market. That's not the lead lag factor. The lead lag factor is watching the very tip of this. Does it twitch up and does it twitch down? And then how fast does this candle change color? That's the lead lag. But obviously, as market direction changed, can you see it here? Where it changed? Right on that doji. They want the market to go up. They're looking for an idea. But then it turned down, and then the thing followed it back down. But I'm here to talk about trend lines. Alrighty. Now, trend line trading can be a lot of fun, but you can see right here that it's failing. Okay, we're getting a candle that's developing under here. Now, we have to wait 5 minutes. Alrighty, to find out what's really going on, we last left our hero at 25.72, and it's now trading at 25.58. What went on in between that? Aha! Now you can see the sell-off there, okay? And on a 1 minute, do you see what the S&Ps are already doing that you don't see on the 5 minute? Yeah, it's coming down. So now people were really eager to take that profit, and they're selling hard right at the top as this thing bends over. And why? Because it's overall a down day. And they don't want to buck the trend. Okay? The trend got bucked a little bit, but they're a little greed. They bought it all the way up in here, and as soon as they started getting nervous here, you see the red candle. The next one, they said, oh, I can't take this anymore. Take the profit. I can't go broke taking a profit. So they took the profit, and it sold off. Everybody had their hand over the table of money. Right here, somebody grabbed it. And then everybody started grabbing at it. Okay? Well, we still, no, that's right now. We still have another 2.5, 3 hours. It's only 11 o'clock. It closes at 1. It said 1400 East Coast time.
So that's 2 o'clock.
Yeah, they close at 4. They got another 2 hours too. So, yeah, we still have a couple more to go. So we can still be in this trade, guys. Alrighty. So again, the last question was, if we're drawing a downtrend line as we have depicted here on the screen, certainly there was a couple of hours there from about 11:30, 12 o'clock to about 1 o'clock, maybe even 2, that the market went flat. So we saw something like this, didn't we? So we drew a line in like this, and when we got a break above, we got out. Then we had consolidation, where the thing went sideways, and then we had another downtrend. I could either draw this trend as a separate line, or I could come back up here and do this. The steeper I draw a line, the faster the trade is over. Why? Because the bottom axis is time, okay? So, again, so that I feed your biases a little bit more, let's go back to an uptrend. All ready? And this is time across the bottom. So if I draw a trend line up at a 45-degree angle, you can see we're going to be in this almost optimized. The price is continuously going up over the course of time. But if I were to draw this line very steeply, okay, well, each candle has to move to the right. So eventually, even if it's a green candle, I'm going to get a close up below that line, huh? Because it has to move. So I'm only going to be in this one for 15 minutes. I might be in this one for 2 hours. And of course, if the line is real shallow, well, I'm not making much money, am I? Because it takes a long time just to go up a little bit. But on the other hand, I might be in this for days, weeks, or months. When we get into this, I'm going to show you guys that about 67 degree up is about as much up tolerance as we can take. Anybody who's ever flown an airplane knows what a stall is, okay? Eventually, you can take an airplane at 45, you get it real high. You know, you can be sucking for oxygen there. But you try to take one like this, and it just falls over. And the same is true on the down, okay? But things can fall a lot faster than they can go up. Oh, yeah. Oh, yeah. After all, gravity sucks. Okay, now, we defined a trend. An uptrend is a series of higher lows in conjunction with higher highs, but the lows control, and vice versa. A downtrend is a series of lower highs in conjunction with lower lows, and the highs control. They are, by their very natures, angled support and resistance lines. Okay? What if we want to draw them horizontally? Well, what is support and resistance? Well, support, okay, is a price level that finds more and more buyers who think right now is a good time to buy, that this thing is undervalued and that it has a greater potential of going up. And so we can see over here on the chart that when we get just below the 49 down to about 48.50 over here, there's two instances where the people said, oh, this is just too good of a deal. We've got to buy it. And you can see that on 321 and then again on 326. That's a support line. On other days, it didn't have to sell off so hard. You can see where it was supporting here on 321, on 325, and again on 320, end of 326, right here and in here. Okay? Conversely, we also have resistance lines, and we'll define that in a second. But if a support line is an area that gathers buyers, what is a resistance line? An area that gathers sellers. Here the people think on 328 and 318 that the thing is just overbought. It's overvalued. We've made enough money. Let's take our profits, and therefore price turns, only to find support again. Okay? So we have this ping-pong ball effect between support and resistance. Now, ladies and gentlemen, there's, again, a lot of different theories in here. It is the consensus of the OTA instructors that a support line is certainly not a number. It's a zone. When we were talking about our famous stock Academy, I said we had support at $30. But is there any real financial or value difference between $29.95 and $305? Not really, not in the big scheme of things. And again, one of the things that was worrying David about whether we were on a 5-minute or a 1-minute candle is that there is movement. There is a shove and a take. You know, if we're going to Indian wrestle, we put our feet together, and then I grab you by the wrist, and there's times when I have you all the way back here, and there's times when you have me all the way back here. We go across center, but the fight hasn't been won yet until somebody's pulled off balance and across that line. Okay? Or tug of war, whatever. The point is that it's not a line, it's a zone of battle. Okay? So when we draw our lines, you'll notice I'm not real fastidious. I draw a line, I have support here, a little bit sticks out, I got support there, a little bit sticks out, support right here, a little bit sticks out, support here, a little bit sticks out. Okay? Kind of as a plug for a friend of mine, some of you guys have Tony Turner's book, okay, Beginner's Guide to Day Trading. and she's a swing trader, and she talks about this. She came up with the perfect technical term for these little things that stick down. She calls them dangly stuff. Okay? I want to know where the majority of the trades are. I don't care if a little bit sticks out, a little bit sticks up. Where were the majority of the fight? Where were the combatants really contesting at? Sure, somebody got shoved over that line a little bit. Sure, somebody got pushed back across that line. That line is somewhere in there, and I want to know where the most of the fighting was. Where's the most dead bodies? I hate to be grim, but I mean, that's what we're really looking for. Where was the real battle? Not over here where the Jeep and the one guy with a rifle is. Where did all the tanks clash? That's where you draw your lines. Okay? Now, let's go on a little further here. That's support. Now, I say that, and of course, immediately I give you a stock here that was the exception to the rule. Okay? This is an old one. We're still in fractions. People say, why don't you update your slides? Because this one was just so cool. Alrighty? Here is a close-only line chart, and 77.15/16 is $77.94. Okay? Look how perfect those touches are on that blue line. It even slid along it. I pulled my resistance line up so you could see it. Very rarely will you have that crisp of a resistance line. Okay? Again, what is a resistance line? It is a price that finds more and more sellers that want to sell the price rather than buy it. And therefore it resists the upward movement of price. Supply is bigger than demand, that's all. So price turns down. When price moves sideways, we give it a number of different names. Some people call it basing or building a base. Some people call it consolidation. Alrighty? When it's orderly, it's called consolidation. But when it's real choppy, it's then called congestion. Alrighty? So if you look up here at the board, here we have what? A downtrend. And then the thing goes sideways for a little bit. And then eventually, as expected, it breaks down. Okay? Well, this basing or consolidation is fairly orderly. We can see where it goes up a little bit, it comes down. It goes up, it goes down to sideways, and finally breaks support. Okay? What if it looked like this? Well, this is congestion in here. It is building a base, but it's not very orderly. And, you know, you can't trade congestion because you're getting jigged out. You have to buy near support, sell near resistance, huh? Yet it's going above the lines, both sides, and sometimes it doesn't even reach them. How many people have ever seen the TV commercial, channelingstocks.com? Okay, well, that's all this we're talking about here. If a stock is in building a base or in consolidation, then it's a channeling stock. And it's doing this. So we can put on a resistance line. We can put on a support line. What's the general rule? Buy near support, sell near resistance. Maybe sell short. Maybe buy cover. Maybe buy long. Okay? But as long as it's orderly, we know exactly what our goals are. If this is $30 and this is $31, we're making $1 per cycle. Maybe we don't get it all. Maybe we're making 80 cents per cycle. Remember, we don't buy at, we buy near. Okay? So, but if I can see this, whether it lasts all day, if it lasts all week, lasts all year, IBM used to be a wonderful stock. It was an automatic. You bought it at 95 and you sold it at 120. Okay? That only went on for about 4 or 5 years. Okay? About every 3 months, you just picked yourself up about 20, 25 bucks a trade. If you see a thing like that, you use the opportunity. Now, the most important support and resistance are the ones that change roles, okay? Here we see that for about the 3 days, we had a support line there at about $45.40. On 9/30, it finally broke through it, and then a couple days later on 10/1, hey, it comes up and it hits its head on the ceiling. It now becomes resistance. The more times we test this line, the more important that line becomes. Why? Well, let's go back to war again. Here we have a resistance line, huh? Okay. And the buyers brought it up and they tested it and they failed. They tried again and they failed. They tried again and they failed. They tried again and finally they broke through and won. Is that right? Everybody with me? What did the buyers win?
The breakout.
But what is that? What is it?
Price.
They got a higher price. They bought it here and they can now sell it up here. Did they make money by winning? Sure. Did they also win honor? We were right and you were wrong. So they saved face, didn't they? They attempted and they failed. They attempted, they failed, and they finally won. Are they big, brave traders now? Yeah, okay. So if the buyers won money and got honor, what did the sellers lose? Face, certainly they were wrong, so they lost honor, okay? Did they lose money or did they lose potential money? Remember, they sold here. They could have sold here. So they lost potential money. It didn't really cost them cash unless they were holding shorts in an inclining market, okay? So they lost certainly the potential, possibly real money. But minutes later, days later, or weeks later, what happens when price comes back down to this famous Maginot line called $45? Okay? Are the sellers willing to sell again at 45? Well, first off, let's do it the other way. How about the heroes of the day? Are people going to buy again at 45? They bought at 45 and they got it up here to 50. Are they going to look to buy again at 45?
Yeah.
Sure they are. Why not? They did it once. Why shouldn't they do it twice? Okay? He shakes his head no, but I'm here to tell you, yeah, they're going to buy again. They like winning. They like having honor and being big, brave traders and making money.
Right. I'm sorry. Yeah.
So they're going to buy. Buyers are going to buy again. You ready? But as the sellers come down closer to this price, what do they remember? Do they remember shame? Do they remember losing potential money? Yeah. As they get close to that price, they go, oh man, last time we were down here at 45 and we sold, we were wrong. Why don't we buy and be like those big brave traders? So as the sellers come down here, they change colors and they become buyers. Now, what happens when you have more and more buyers at a price? Is that support? Boom, price turns around. You have the regular buyers, the winning buyers, plus the converted trader sellers to buyers, okay? And so this line starts to repeat. What happens when it comes down here again? Well, again, it's going to repeat unless there's some exogenous news out there. What if the sellers win this time? Well, later, when it comes back up, the coward buyers are going to turn turncoat, and they're going to become sellers, and it's going to become a resistance line. But you know what everybody's going to remember over the course of this last 6 months? $45 is an important number. Okay? We either made our fortunes or we lost our fortunes there. And 45 is going to be indelibly burned on somebody's account. Okay? So 2 years later, hey, let's have a look at that GE. Where's that trading? 45. You know, I don't remember why, but I start to get the shakes, okay? I think I'll sell short, you know. So again, we're looking for old support lines tend to become future resistance lines and vice versa. The more times that they are a battle zone, the more important they become in the future. Okay? So if we start looking out, and GE happens to be a very classic one. GE in 2002 held $32.50 for a long time before it finally broke along with the other stocks. Right now, for about the last 4 or 5 months, GE has been hitting its head on $32.50. That was 4 years ago, guys. It's trading right between 32 and 32.50. Let's take a quick look. Just a fast peek here. Okay? Maybe it got through, but I don't think so. GE, please. The last couple days it's fallen down, but let's go back just a little bit further in time. Well, it did get through the 32.50s, but here's the 32.50 line right in through here. Okay? There's 32.50. And you can see where it broke out in right here. It was coming up, it felt the resistance, but it pulled up. What was the market doing? Rallying strong. Couldn't hold it, came down and sat on that 32.50. What was resistance has now become support, and it's finally broken it. What then when it comes back up to 32.50? It's going to be a resistance line again. They're going to hit their heads on it. Everybody's going to go, oh, I remember this. This is a crummy number. How far back do you go? Far back as you need to. Okay? If you look back far enough in time, you will find repeating support and resistance lines at a variety of different levels. And the more times that they're touched, the more important they become. Okay? Ultimately, trends do change. Okay? We can't expect things to continue ad infinitum. We know that Newton's third law of motion is cool, but ultimately there is outside agencies at work. How do we know when trends are going to change? Well, we look for trend reversal signals. Let's have a look. One of the first one is the double top. Okay? Now, first off, if it's a trend reversal, that means you must first have a trend. Okay? If we looked at my consolidation in here, is this a double top? No. It's not going, it's not trending up. We don't have a series of higher lows. We had a trend over here. Okay? Is this a double bottom down here? No, it's not a downtrend. Okay? So you got to be careful about making sure you apply definition. Now, what does a double top say? Well, it says we have an uptrend, and we do have a series of higher lows. The buyers buy it up. The sellers take over and sell it down. The buyers make an exhaustive effort. You see how stretched the bodies are here and that there's gaps? They're trying. But the sellers just take over, and sure enough, we start getting a series of higher lows. Okay? The trend has now been reversed. When we start getting into this in depth, you're going to find the distance from the highs to this V bottom is a measuring object. And you guys can pretty much see that this distance here is about one full block. You guys see the dotted blocks? You got about a half a block and a half a block, okay? And if you look from where it broke, okay, it's about one full block to where it found the bottom. Not perfect, but that's what we call a measuring object. We'll get into that. We also have double bottoms. Now, double bottoms don't always have to be perfectly matched. We have a number of things to consider here. Certainly we have a downtrend, a series of lower highs. So the first part of our requirement is filled, right? We have a trend. But now the question is where is the double bottom? Well, I have two touches right here and here at $41, which is a natural support line. Did the price go up? Well, a little bit, but then it came back down. Well, if it came back down, maybe this is the bottom and this is the bottom. Do they have to be perfectly matched? No. No. Generally, the accepted rule of thumb is within 3 or 4% of price. So if they're just a few pennies off from this low at 41 to this low at 41.10, okay, probably that is a bottom. How do we know? Well, the thing fulfilled. Did the trend reverse? Startlingly so. It really went up. Alrighty? Again, if you note that if we drew this angle in here, the distance from here to here, okay, is right where this thing started to top out here. It did go up a little bit further, but this would have been getting a little scary. Can everybody see that topping tail in there? I know it's kind of small, but this would have been a good indication to what? Maybe take 50% of our profit off the table? Did this thing go up vertically like an airplane about to stall? Probability was that it was going to fall over. The fact that it actually went up a little bit more is actually remarkable.
34% is a good zone.
Yeah. Down in here? Sure. Now, why do double bottoms and double tops work? Well, because somebody read a book. And somebody wrote a book and said, if you have a downtrend and it touches this price twice in a row within a significant period of time, the trend will reverse. People read that, they see it touch the second time, and they start to buy. Again, it's a self-fulfilling prophecy. But it does not matter. Who cares? I'm going to start buying it. When I start to see it go back down, I'm actually going to buy it somewhere in here. Why? I need red candles. I'm a buyer. I want to see sellers. Give it to me, give it to me, give it to me. My stop loss is going to be what? Anything below that, 41. Not 41, below it. I want to prove that it's going to break support, that it's truly still going down before I'm out. So my stop loss, if I get in here at around 41.10 or 41.15, my stop loss might be $40.90 or $40.95. I want to make sure it goes across that line significantly. Okay? I want it to prove to me I am wrong. I don't want to prove that I'm right. A lot of people do that. They'll set their stop loss at $41 there, and the thing will bounce off of it, and they go, wow, I was right. It cost me that trade because I'm out. Okay, another trend reversal is what we call a head and shoulders. And this one we used to scare our students with. Already, this one has broken down and has not fulfilled. Thankfully so, because this was the S&P 500 on a weekly chart over the course of about 4 or 5 years. Okay, and it's one of the reasons that all technical analysts last year in 2003 were very, very frightened that we could go way down. I don't know if you guys have read about people like Prechter or Malden or some of these other people who are predicting 5,000 on the Dow and 200 on the NASDAQ, okay? But it was possible. It was. A head and shoulders is a trend reversal for an uptrend. Now, you don't see much here, but would everybody pretty much agree that from 1991 to 1998 we were in an uptrend? Okay? Well, we were. If you don't agree, I'll tell you we were. Okay? The buyers bought it up. The sellers sold it off viciously. The buyers found support right above these tops in here. Okay? The buyers took it up, ran out of steam. You can see where they started becoming exhaustive. We have almost a little double top in here too, don't we? Right here and right here. Yeah? And they took it back down. They tried again. And then the sellers took it all the way back in here. The buyers rallied. You see another little double top right here? And then it broke through. Now, I didn't draw this neckline, this blue horizontal line, perfect because I wanted it right on the 1,000. Does everybody see it would really be all across here? Right. And touching these tops over here and these bottoms and this bottom and this little notch right here. Okay? The reason is because I wanted to talk about the measuring object. The distance from 1,000 to 1,550 is 550. If you subtracted 550 from 1,000, that would be what? 450 on the S&Ps. 450 on the S&Ps would equate to a Dow 800, a NASDAQ 800, and a Dow about 5,200. And that would get everybody's attention. What happened? It came back up, people. And we're now trading what? Right around 1,100 up in here, okay, on the S&Ps. How about an inverse head and shoulders? Everybody see it? Well, the computer will draw it in for you here in a second. Again, we have a downtrend as described by a series of lower highs. Here is our upside down left shoulder. Here is our head. Here is the right shoulder. And here is our neckline. Now, again, I don't know if you guys can see this gray-purple line going through here. It's right there in the tip of the head. You guys see that from the neckline to there is about 1.5 squares. 1.5 squares up is where we find this little double top. Now, it did go on beyond that, but do you see where we started to hit resistance right around there? It's a very useful tool. If you start to see this, you know to go long, and you can start to say, oh, I've got this much more money I can make in it. It's the logical goal to shoot for. Okay, some of them are a little hard to see, okay? Here's another shot of the inverse head and shoulders. Now, this guy is the Hunchback of Notre Dame, okay? He's lopsided. Can you see the left shoulder right here? And this is the right shoulder. This one is a V bottom. This one is rounded. But this is his head because he is, well, he's like this, isn't he? Okay? I can't stand, don't ask me to stand on my head now. Okay? So his neckline is angled. Okay? Again, if we were to measure the distance from the head to the neckline, from where it breaks out to here is just about that distance. Right where you start to see this little consolidation in here. Again, the measuring object. Questions so far? One of the most important things out there is volume. Volume is the pressure behind price. It drives price down the railroad tracks. You see my little locomotive up there. My mentor, Sal Goldberg, he said something to me that I found a little bit poetic, but it also really kind of stuck with me. He said, Mike, remember, volume is the music, price is the lyric. Without the music, the lyrics don't work, okay? And you got to have the volume there. It determines whether we have momentum strength in the volume, okay? It determines the strength of the move. We just looked at that last breakout on that head and shoulders down there and how vertical it went. Well, if we had had a volume chart on there, you'd have seen big volume pushing that price up. And when volume starts to drop off, okay, then the price will start to falter. How about when price goes down? Well, when it goes down, when it violently moves down, there'll be big volume. People will be selling. What happens when volume drops off? What does price do? It goes sideways or drifts down a little bit. Why does it drift down? Don't tell me that gravity sucks, okay? Remember that greed and fear is always the stronger of the two emotions. So left unattended, price will always go down a little bit because there's always a few more sellers than there are buyers. There's always somebody with a touch of the anxious, the antsies, okay? Here's a general rule for you guys. Consider opening a transaction on increasing volume and closing a transaction on decreasing volume. Okay? Again, it's a general rule. There are some times when you can open on flat or slightly decreasing in anticipation that volume's going to come along, but this is a good general rule. If I'm in a trade and I'm long and I see price going up and I see volume supporting it, just like my timbers on my road there that we drew earlier, what happens when volume drops off? Can price continue to go up? No. It's at best going to go flat or come down. Again, this might be an indication, if not to close the transaction, how about at least taking 50% off? People, that's always a good move. Once again, there's nothing wrong. As long as you leave it on the table, somebody else can pick it up. But you put it in your pocket, they can't get to it. All righty? So don't be afraid to spend an extra commission to put some of that cash into your pocket. Now, when we have higher volume, we generally, not always, but generally we have stronger support. And on this little example over here, on the left-hand side of the diagram, we can see that the buyers and sellers are contesting very highly at this level. And that's why the left one probably will not be penetrated. On the other hand, on the right-hand side of the diagram, we can see that volume has fallen off, and as price comes down to this new little support line, could it go through it? Sure. Remember, when volume falls off, price wants to drift sideways or go down. Any kind of a selling pressure might make it happen. So your lines of support and resistance become even stronger when there's higher volume. Now, this isn't perfect, guys, because if we look at the board up here for a moment, what about angle of attack and all these other things? Here we have a support line, and price comes in, and we see volume starting to increase. Well, we can probably figure that the buyers are arriving at that level, and it's going to deflect. Okay? Well, we're going to get into that because we'll actually be able to see these volume bars as red or green, okay, whether they're accumulation or distribution. But what do we suspect around the support line? Up volume, because why is it being supported? Because it finds more and more buyers. Okay, so we suspect that these are going to be green. All righty? But what if we have the support line and the thing is coming down very sharp like this, and these guys are red? Well, maybe that support line isn't going to hold. Okay? So there's nuances in here. I'd love to just say 100% of the time, but you'll never get me to say that, people. For every rule, I can show you the exception. And I want you always looking for that exception. Don't always look for things that support you. Look for what can damage you. Always be kind of a defensive trader. Remember, what is the heart? Is it making money or learning how not to lose it? Learning how not to lose it. Always be looking. Somebody sneaking up on me? Somebody grabbing my wallet? Okay? I'll find money along the way as long as I keep what I got. Okay? We're going to spend an awful lot of time with volume, but I also want to go in right now and talk to you a little bit about gap play. Okay? Gaps occur regularly. Okay? They tell us a lot of things about what's going to happen for the rest of the day. And what we have up on the board right now is a gap down. Okay? So obviously there was some bad news overnight in this stock that caused it to be devalued overnight, and we see a change in price dramatic. But if the price was coming down and it closed and it gaps down, let's say it closed at 20 bucks and it opened at 18. Are there any orders to buy or sell at $19.90 out there? Sure. Okay. Maybe there's some to say sell it at $18.50. There may be even somebody who put in a real low limit order to buy at $18.25, right? These are limit orders that people forgot to cancel or they haven't gotten around to looking at it yet. Surprise, gap down. All righty? So as this thing gaps down, are some of these people being filled? Sure. So that causes the price to do what? Come up a bit. All righty? There's a lot of different theories on why gaps fill. Okay? One student said to me, he said, well, Mike, nature abhors a vacuum. I'm sure that there's some influence in there. Somebody says, well, gosh, it can't be as low as 18. It's got to be worth something more than that. They oversold it off. There's a lot of reasons, okay? Does it matter? No. the result of the gap filling pressure matters. Now, gap filling takes place from 9:30 East Coast time until about 10:15. All the instructors here, they like 10:15, except me. I like 10:30. I give it a full hour. But from 45 minutes to an hour is gap filling time. Now, here's the distance that the thing has gapped down. I'm going to give you some percentages. We're going to spend a whole lot of time on understanding where Fibonacci got his numbers and his different views mathematically of how things work. But for right now, I'm just going to use them. So if the thing gaps down and it only fills up in that first 45 minutes to an hour 38.2%, then this stock is going to be weak. It doesn't have much strength to it. And in fact, will close below its opening price 70% of the time. Okay? If in that same period of time, the thing fills up here to 50%, well, we have a real good technical term for this. We say it's so. We don't know where it's going to go, okay? It's so. It doesn't have weakness or strength. So now it requires patience. We have to watch to see what's going to happen. If in that same frame of time, it closes at 61.8%, which is the opposite of 38.2, then the thing is starting to show some strength. So it's a little bit strong, huh? In fact, if it closes 61.8 or higher, it will close above its opening 60% of the time. Okay? Now, this drawing here misleads you. What is above opening? Is 1801 above 18?
Yes.
Yeah. So all it has to do is reach 1801 by the end of the day, and it fulfills this. Don't get excited. Don't say, oh, it's got to go above 20 like I draw it. I draw it so you can see the numbers. Okay? And of course, if it fills 100% or greater, okay, then it's very strong. And we're looking for a long, all day long. Everybody with me so far?
100% would be up to 20.
Above, beyond $20, yeah. In the first 45 minutes to an hour. Now, here's a gap down, okay? And I think you guys can see, without me actually drawing on the screen up here, thing closed at a little bit above $43, okay, and opened at down here at around $37.50. Remember, a green candle opens down here, okay? That red arrow isn't really good, is it? It should really be pointing down here, okay? And we can see that by 10:30, this is as high as it got. And you guys don't have to be math majors to get your calipers out, but can you see that that's less than about 1/3 of the entire gap? Alrighty? So what would we suspect about this stock? As the day wears on, would we be thinking long or short? Short. Excellent, Jim. Jim was the first one to go like this, point down. Okay? Very good. Good knee-jerk reaction. Down. Okay? So we're looking for an opportunity to get short in this thing. But what's our volume tell us? When do we open a transaction? On increasing volume or decreasing volume? Increasing. Do we have increasing volume, or is it getting less and less? Less and less. So we still have to be patient. We don't have our opportunity to open our short yet. I'll do it. I'll draw it all up here, but you guys should be able to figure this one out. What if it gaps up? Well, then it's just the reverse of what I put up here for you. Again, we are going to be looking for the first 45 minutes to an hour. The price closed here, and it gapped up. So now we're going to expect it to fill downwards, aren't we? So what if it fills down to 38.2%? Well, now it's strong. And again, we're going to look for a 60% chance that it's going to close above its opening price. If it fills down to 50%, Okay, again, it's so-so. We need more information before we can do anything. And if it fills greater than 61.8%, then we know that 70% of the time it's going to close below its opening. And of course, last but not least, if it's greater than 100% fill, it's very weak. Everybody got it? Now, don't worry about where I got all these percentages. You're going to come to know and love Leonardo Bonaccio's Pisano, a.k.a. Fibonacci. Yeah, we'd be anything beyond 61.8, we'd be looking to go short, and anything at 38.2 or less, we'd be thinking about going long. After all, it did have good news in it, didn't it? It gapped up. Okay, here we have a gap up and a partial fill, and you start to see why we look at this. Can everybody see that it closed on the Friday the 15th here, right here at the top of this green candle, even though it was on an overall downtrend, okay? And the next day, on Monday, it opened here, so this is the gap between the two greens. We did, within the first hour, get a little bit of a fill here. But again, if you just eyeball it, you can see that this fill is less than 1/3. And we're actually willing to go almost, what, 40%? 1/3 is, what, 33%. So here we saw a stock that had some fairly good strength in it. It recovered, and off to the races it went, and it certainly closed above its opening price. Now, the next section we need to talk about starts to get into a little bit of the personal stuff. You all have very, very good questions. You're worried about, well, what kind of a trader am I going to be? How am I going to find my style? A lot of schools out there, they say, oh, you have to do it this way. You got to do it our way. It's the only way. That's completely untrue, people. I'm sorry. I wish it were in a box. All you had to do is put tab A into slot B, and you'd make money. That's not how it's going to work. We got to find out who you are. So let's talk a little bit about the different styles of trading, and then we'll start to expand that into later about how we can put those into a trading plan and start to test them. Okay? Because you don't honestly know. I don't honestly know. I can look at you, I can watch what you do here. When we go trading live, I'll notice that you have peculiar habits. You'll really like to draw lines on the chart, or you'll really be looking at a level 2. And that'll give us both a little bit of inclination of which way you're headed. But you won't know literally for weeks until you try and go out and, I'm going to try this on a 1-minute chart. I don't seem to make any money. I'm running up a lot of commissions. I don't really see it. I'm going to switch to a 5-minute chart. I'm going to make a little bit more money, and I'm doing less commissions. Oh, that seems positive. I'm going to stay with that for a while. No, it's still not working out. Maybe I need to go, and I'm going to trade over the course of hours with a 15-minute chart. Maybe I don't see what Mike was talking about in those prints. I'll get back to them later, okay? These are all trials, tests that we have to make. And if you will, I mean, I can make this sound very, very important. It's called the scientific method. You first come up with a hypothesis. You want to trade. That's the hypothesis. The theory is, I'm going to be this kind of a trader, or I'm going to be that kind of a trader. We then take that theory out and we test it until it is repeatable or not repeatable. If it's not repeatable, then we have to go back in and look at our theory again. Alrighty? And we come up with another theory B, and we go out and we test that until we start to see that it is working enough that we can tweak it. But if it fails, so no matter what system I gave you, you're still going to have to go out and test it. So we might as well start from the ground level. So let's have a look at some of those different styles. There are 4 classic definitions to trading. Okay? There's scalping, momentum, swing, and long-term, or what we call position trading. Okay? The terminology for them comes from where the information that controls the trade comes from. And I'll talk about each of those as we get into it. But it doesn't matter which style you use, you have to go in with a trade plan, and that trade plan has to use the zealous use of stop losses. Okay? Now the first one is scalping. The classic definition of scalping was the ability to buy it at the bid price, all of the market maker, and immediately sell it at the offer, at the ask price. The object here is what? To capture the spread. Well, scalping virtually went away when we went to the decimal system because the spreads went all the way down to a penny, okay? And if we start to play a stock that has 5 or 8 cents spread in it, it's too volatile and you can get hammered. I'm going to show you some examples of that. So by and large, as long as we have a 1 penny spread, the classic definition of scalping is almost a dead issue. It's almost a lost art. As I said to you earlier in the class, there is talk on the street right now that they may try to artificially inflate it back to a nickel, so that the minimum would be a nickel. Well, this would be bad for the Joe lunch buckets. They'd have to be giving up at least a nickel in price. But for us traders, it would be kind of a good thing. Because now with 1,000 shares, if I could buy it at the bid and immediately sell at the offer, I make 5 cents on 1,000 or $50. If I have even I consider 10, 12 bucks expensive in a trade, I mean a ticket. So if I have 10 in and 10 out, that's $20 for my commissions. Well, that still leaves me $30 net, rough net, plus or minus a little bit. Okay, now if I do that 10 times a day, I make myself $300. If I do it 100 times a day, I make myself $3,000. Okay, so that's the joy. I mean, scalping is very quick. It's boom, 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 boom. And you saw that one guy's trade sheet. In an hour and a half, he had done 137 tickets. Well, that's divided by 2. That's roughly, 60 round trips in an hour and a half. So that's a trade, 1 round trip every 90 seconds. Okay? And he was probably having a cup of coffee in between. So when he was actually trading, he was doing it very quickly. So scalping may come back. But again, let's go through it here really fast. The object is to capture the spread. Okay? The dime frame is obviously seconds to just a couple of minutes. The unit target used to be a nickel to a dime. Okay? We used to have what we call teenies. A teeny was 1/16, okay, which equated to 6 1/4 cents. So we would play for teenies, as 1/16 or an eighth, which would be 12 1/2 cents. Alrighty? That made it viable for a reasonable share size of 1 or 2,000 shares. Okay? It says stop loss of a nickel. Guys, we haven't really talked about this, but your stop losses are not hard numbers. They're based on 2 items. A stop loss is generally 1/3 of your profit motive. We want to try to maintain a 3-to-1 profit to risk ratio. So, if I can see that the thing can move 15 cents, well then my stop loss might be a nickel. If I can see that the thing is going to move $1, my stop loss might be as much as 33 cents, but no more than that. Okay? The other thing is I say, okay, 33 cents or the next technical stop. So if I went long and I had a support line that was at 27 cents, that would really be my stop. Even though I could go 33, I would want to save some of my money and use a technical stop. Does that make sense? So again, what we want to do is we want a reward to risk ratio of 3 rewards to 1 risk. So that means we have to be able to determine how far the stock is going to move. Okay, that determines what our reward is, and then we would never exceed 1/3 of that in risk. Now this is true for stocks. In some other instruments, something like Forex, okay, or futures, you might go as low as 2-to-1. Alrighty? But that's because of a lot of different things. They don't have as many hidden fees and ECN fees and stuff that we have to cover. Why do we do this? Well, let me just show you a quick demonstration. If we have 1,000 shares and we make 5 cents, okay, as I said, we're going to make $50. If our commissions are 10 in and 10 out, we subtract 20, we make $30 net, right? What if we lose 5 cents? Well, then we're down 50 bucks, okay, down 20, okay, so we're really down, oops, not 80, 70. Come on, math majors, okay, we're down 70. We can't afford to lose a nickel as often as we make a nickel. So we have to lose far less than a nickel. So what if we lost 2 cents? Okay, well, then this becomes 20, and then this becomes 40, already. And if we made 6 cents in this, this becomes 40. So now with costs and stuff, we at least reach some equilibration at a 3 to 1. Everybody see that? So that's why we kind of, now, I found a great trade, and there's only about 2.5 times 1. Take the trade, tighten your stop a little bit, you know? I mean, it's, once again, these rules are rules, but they have to be massaged to the situation. Every trade is situational, people. I use the analogy about golf, okay? Every golf shot is situational. You may stand on the tee, but today, because there's a little bit of wind, you choke down and you don't take quite as big a backswing. Same club, same ball, same concept, get it down the fairway, but you're going to change just a hair to match the situation. We're going to have to do that maybe with our trading. So, and then of course, we're talking about scalping here, so we're talking about real tight. What does it say down there under the trader's #1 factor in a scalper's success? It's almost zero tolerance. We can't afford to let it go against us, okay? Because we only intend to make 10 cents. The most we can risk is 3 cents. The moment the thing goes against us, it jigs us out, okay? One of our instructors, Mitch Carriaga, is a high-speed momentum trader. He's not truly a scalper anymore because he, once again, it's hard to scalp a penny. But he's still in there. His attitude is very simple. You guys will probably chuckle at this. He believes that whenever he opens a trade, he's automatically going to lose. So the moment he opens, he's looking for a way out. If the thing goes with him and starts making him money, he's surprised and delighted, okay? He won't open a trade unless the next tick is in his favor. And if it goes against him, he's out, okay? Because it was going to go bad anyway. That was his attitude. And so he's just surprised and delighted when he makes money. The guy does really well. Now, I don't like going in there with kind of like a losing attitude, but my gosh, it works for him, okay? And I can't knock success, okay? If you are going to lose, you've got to keep it to a very, very small minimum. Lose very, very little, okay? Needless to say, execution knowledge and eye-hand coordination speed are key. Now, when I showed you our little executions earlier today, I used a mouse. No, people. If you're going to be a high-speed scalper, you've got to use a keyboard. You've got to be able to hit F1 buy, F2 sell, F1 buy, F2, F3 sell short. Keystrokes are much faster than mice are. Or is that mouses? Mises, that's what, Mises. Okay. Now, what's the detriment to this? Well, certainly you're going to have a high cost in commissions because you're in and out, in and out, in and out, in and out. And you also have to have some pretty good cash behind you. Again, we can't go in there and buy 100 shares and make any money. We got to go in there and buy 1,000, 2,000, 5,000 shares on only a couple of pennies to make any serious money. So that means you have to have a lot of cash in the account, okay? But some people say, well, Mike, this is really high risk. Let's think about that a moment. A scalper is in and out of the market every few seconds, okay? At any given point, he's out. Nothing can go against him, all righty? So who's more at risk? A guy that holds the stock for a year or a guy who holds the stock for 10 seconds? Guy who's in the buy and hold, okay? Now, I admit, scalpers spend a lot of money in commissions, okay? They're in and out all the time, already, and they do have to have some big horsepower. But they're really not very big risk takers because they're shooting for what? Very small rewards. Let's take a quick look. This isn't the best example. It's hard to show you scalping on a static screen. But here we have a scalper who may take advantage of a spread like this, okay? And we can see, what do we got up here? Ballard Power Systems. And it's trading 93 by 98. We got a nickel spread in there. Yeah, not bad. Okay, so perhaps we can go in there and join Charles Schwab, okay, at the 93s and put a bid to buy. If we get filled, we could immediately come over here and join Lightspeed Island and Inca at 98s and sell it. What's the problem with that? We're in competition, okay? So maybe we front run these guys a little bit. Could we come in here and be the best inside bid at 94 by ourselves? Yeah, sure. And if we got filled, we could turn around and go in here at 97 already and try to offer it up for sale. But again, you guys can read this. However, the high volatility of the stock makes it much riskier to scalp. Why? Well, guys, look at the share size. The biggest thing up there is what, 700? Yeah, I see two 700s there. How are you going to buy 1,000 shares? Who are you going to sell it to if everybody else is only buying 100 or selling 100? Doesn't this kind of define what the market is doing? Now, some of these may be hiding share size. Maybe I'd have to look at the prints to see what's printing. But if all I saw were 100s and 300s and 200s printing, that means I wouldn't be able to sell 1,000. Okay? The other problem is what? I just went 94 by 97. I reduced that nickel down to 3 cents. What's my stop loss maximally? 1 penny. Okay? So I can't afford to have this thing go against me. This is a more risky stock. In the other level 2s that we've looked at, haven't you noticed that the blocks have been much bigger? Okay? This is what we call a coral snake. Okay? If you've ever seen a coral snake, they're a little bandit snake in the southeast. It's a 1.5-step snake. If it bites you a 1.5 steps later, you're dead. Okay? Well, a coral snake in stocks won't kill you, but they might kill your account. Alrighty? Can you see if I got filled at 93 that the next level I could sell to is 90? Wait a minute, you said a 1 cent stop, Mike. My first out is 3 cents away. That's a high risk trade, isn't it? For a scalper. So you can see that as we start to go up in spreads, we start to go down in liquidity. Our doors out of this place start to close. I'd like to be able to get out at 92 or even 91, but my first choice is 90. And there's no guarantee that these guys are going to stay there and hold their orders. How long does Merrill Lynch have to stay at 30.90? 5 seconds. Okay? And we don't know when that 5 seconds started. The next one is momentum trade. And a lot of traders today call themselves scalpers, but they're really momentum traders. And momentum, everybody understand momentum? If I took a quarter and I flipped it into the air, it would leave my hand very quickly. And as it reaches its apex and gravity starts to pull on it, it slows down. And then it comes back down at an ever-increasing speed. It falls at what, 32 feet per second? Per second, it's increasing as it comes back down. And this cycle repeats, alrighty? So that's what momentum is. So a momentum is based on level 2. Where are the bids and the quotes, and what are the prints doing? Okay? And this is how we momentum trade. Now, these trades are typically a 1 or a couple of minutes. Obviously, a momentum trade cannot last at the end of the day. Okay? The market closes. There is no momentum. Okay? So the unit target gets a little bit bigger. Now we're starting to look for 25 cents or 50 cents in a move, maybe even $1.50. Things take off and like to run. Okay? And we want to be in on it. When a stock looks strong, there's no reason to sell. Now, I told you at the beginning of this that these were classic definitions. do we have any blurring? Sure. I mean, what if we saw the stock really taking off, and we said, okay, we're going to buy it in here somewhere, already, and we should sell it as it nears resistance, right? But it goes right through resistance, retraces a little bit, and continues up. Well, if we decided that this is now support, we've actually become a swing trader because we're using technical analysis. We're not looking at the level 2 so much. Now we're starting to trade it technically. Okay? And that's what the definition of swing trading is. We want to hold on until momentum slows, not reverses. Remember our cycle. We don't want to get on the other side of the hill and be selling in competition with other sellers. Or if we're short, we don't want to be buying in competition with other buyers. Okay? You get out when you can, not when you have to. Lead the duck a little bit. If you shoot at a duck, people, you'll miss. You gotta, as the duck flies across, you gotta shoot out here and lead the duck a little bit. You gotta start to wait for that thing to go up that hill and start to slow down, and then we get out. We don't wait for it to stop or reverse. Okay, we get out when we can. Again, if we're shooting for 25 cents or even $half, what do our stop losses become? 1/3 of that. So, you know, if it's shooting for 25 cents, our stop loss might be 7 or 8 cents. If we're shooting for $0.50, our stop loss might be 15 or 16 cents. Again, maintaining our 3-to-1 profit motive. You ready? Obviously, we'd love to let our winners run, but again, we can't afford to take much risk. Guys, 5 or 6 cents isn't much in a stop loss. Stocks vibrate that much all the time. So we have to really pick our entries carefully. You ready? Obviously, you're going to need good expertise in reading level 2 in the prints, and you're going to have fair to good execution skills, because this is going to take place quickly. You're going to have to decide that it's running or it's not. Now again, because these are static screens, it's not the world's greatest example, but you guys can clearly see that here we have eBay on a 5-minute candlestick on 8/20, August 20th. And you can see where the stock was moving down and then sideways. Okay, we can see where volume started to spike up in here, and the thing was off to the races. Now it moves, at this point, it moved from what, 109.50 up to 110, 110.50, okay? So there's at least $1 movement in there, and it takes place in less than 5, 10, 15, 20, 25, 30 minutes before it starts to slow down a little bit. So this is a pretty fast trade. And by the time we see it, identify it, and we get in somewhere around 109.75, and we're getting out around 110.50, we've made ourselves 75, 80 cents, okay? And it took us 10 minutes to do it. I know that 75 or 80 cents doesn't sound like a lot, but again, on 1,000 shares, that's a $750 winner, okay? On 500 shares, it's a $350 winner.
Yeah, but the times 110, that's a lot of money.
And your point is?
I'm just saying, you need a lot of cash.
Well,
There's a
sure.
lot of money there.
Sure. But remember, you get 4-to-1 too.
Oh, yeah, if you're more.
So if you want 1,000 shares of a $100 stock, that's 100,000. How much cash do you have to have? 25,000.
Yeah, right.
Okay. So it's not out of the realm of possibility, but could we go find another stock that plays at $50 that does this? Sure.
Yeah,
This just happens to be an expensive example.
yeah, right.
Okay. Conversely, after the lunch period is over, we start to see the things slip off. And again, what is our cue? Do we see increasing volume in red down here? Do we see a staircase? Bing, bing, bing. Okay. We're going to jump on this thing short, and we might get another $0.50, $1 out of it. Okay. So this would be a momentum trade. Now, swing trading, if you've read any books on swing trading, a lot of traders make a mistake, and they say a swing trade is a trade that lasts 2 to 3 days. That's not what makes it a swing trade. The definition of swing trading is swing low to swing high technically. As I drew up here earlier, we have a support line and a resistance line. Swing low to swing high to swing low to swing high. It's a technical challenge. Therefore, swing trades, if you're looking at a chart, even if you only intend to hold this thing for the next 10 minutes, it's officially a swing trade. Now, I admit that most swing trades do take 2 to 3 days to develop. Alrighty? Again, they're based on technical analysis, but a trade might be 10 minutes. Certainly, it's less than 2 weeks. Okay? By the time you go a week, you've hit some sort of a technical break. Okay? So, here we're not shooting for pennies anymore. Now we're looking for dollar bills. Alrighty? We might be looking for $2, $3, $5, something like that. Again, we're trying to define a distinct trend or pattern and stick with it until that pattern breaks apart. Our stop losses are stretched. Again, if I'm starting to look for a dollar bill, I might go up to 33 or 35 cents. If I'm looking for $10, I might go to $3 stop loss. Yes, Al?
Wouldn't you have a different stop usually for a swing trade?
Yes. Yes, obviously you're going to find something that's trending more, and a momentum trade would be a more volatile stock that goes up and down, you know, in a short period of time. You wouldn't expect them both to do it. Okay? And as I said to you guys, I expect you guys to start out with 1 or 2 stocks. This year I intend to play with 7 stocks. I have 7 candidates picked out, and so far through the first 3-4 months of 2004, I've only played 5 of them. Okay, the other ones haven't hit any trigger points that I want yet. And I do very, very well that way, people. But Mike, can't you trade more? Yes, I can. But I don't need to. And every time I trade more, I actually make less money. This is kind of my happy medium where I found there's enough data that I can monitor it and watch it. Okay? Now, I put up in here myself, I put a maximum of 40 cents. I want to talk to you just for a moment about that. Guys, I think a little bit differently. You ready? I think in terms of valuation. 40 cents on 1,000 shares is $400. Okay? Would I rather lose more than $400, or would I rather spend a week in Maui? Okay? Right now, you can fly round trip to Maui, okay, for about $389, okay? That leaves you another $100 for Mai Tais when you get there. Okay, so would you rather lose $400, okay, or would you rather spend a couple days on the beach? Tough call, okay? Because we could make a lot of money where we could spend a couple of weeks on Maui, couldn't we? That's our reward if we do it right. But my point is that I get to the point where I will not take much more than about a $400 or $500 loss, irrelevant of the position. That just gets too expensive for my blood. So here's where I break down. Doesn't mean you have to, but this is where I start to break down on the 3-to-1 profit margin. If I can see clearly I can make $6, I'm not going to lose more than 40 cents. Okay, that's my personal stop loss. You ready? You may, I can get a bunch of traders in here and say, oh, no. You've got to let the thing swing a little bit. If you're going to expect to make $5, $6 on it, you've got to give it $1 or $2 to make it happen.
The risk ratio.
Yeah, you can at least keep the risk ratio. But at least keep that, guys. You know, I mean, don't go in there and say it's a $6 move, I'll let 4 of it go away. No. You still at least keep it to the 3-to-1. Alrighty. The neat thing about technical trading is that we have a goal, don't we? We know that we're going to buy near support and that we're going to sell near resistance. So we know how much that is. Okay? We already have it pre-planned. I make a comment about this because this happened to be one of the big hurdles I had to get across. People, I mean it was a big one. I would look at a chart and I would technically trade a stock, and let's just, for the sake of discussion, say that there was a $2 move in it. Well, when I got up to about $1.80 of that $2 move, my little greed demon would get in my ear, and it would start going, Mike, listen to me, Mike. This is the one. This is the skyrocket you were looking for.
Oh, that sort of greed.
Yes.
Okay, as opposed to quick grab your profit.
No, that's fear. When you quick grab your profits, that's fear. We'll talk about that. Okay, but this monster would get in my ear and say, skyrocket time, Mike. You were looking for a skyrocket. Here it is. It's gone to $4. And I would hold on, and I would hold on, and the thing would erode, okay, and I would lose all the profits I had made. Well, I wasn't looking for skyrockets. I was looking for $2. Okay? When I look for skyrockets, I need to look at in a different area. Okay? But it took me a long time to get that through my thick Irish head, okay, that when you look for $2, take $2. If there's more, buy it again. We're not here to buy, hold, and hope. Ladies and gentlemen, we're here to buy and sell. We're merchants. We turn over inventory. The question has come up a number of times. What kind of a trader am I going to be? Am I going to be a fast trader or am I going to be a slow trader? Well, let's talk about that for just a sec again, okay? Because I really want this clear in your heads. If you guys are going to deal in fresh fish, you're a fishmonger, okay? You sell mackerel down on the pier. How fast does your turnover have to be? How long can you keep a fresh mackerel out there in front of the public? I mean, you really want to sell that in the next day, at least today, okay? By the end of the week, that's going to be one bad fish. On the other hand, how about a car salesman? Does he sell a car every day or does he sell a car every couple days?
Couple days.
Yeah. How about a real estate guy? He turns a house over, what, once a month? Okay? But he has to turn it over. He has to find out what his industry standards are for house turnover and match it, or he doesn't make a good living. And how about the guy who builds shopping centers? He may do one project a year or maybe one every 5 years. Okay, an architect. So they're all merchants, but they all have a different time frame on how they see the turnover of their inventory should go. But turn it we must. Because if we don't turn over inventory, we're buy and holders. And we're not, we're traders. Obviously, we need to be able to read charts, draw lines effectively. We have to have good technical analysis.
Mike,
Yes, Jim.
I still don't understand the difference between swing trading and momentum trading.
Momentum trading, again, remember, the name comes from where the information is derived to open the trade. A momentum trade, we're looking at the bid and ask and the prints. Okay, we see them going green, 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 yellow, green, yellow, green, yellow, green, yellow, green. That's a momentum trade. We're looking at the prints. A swing trade is a technical trade. So we're looking at only a chart. Okay, we're looking for a trend line, a series of higher lows, or we're looking for a breakout of support or resistance. We're looking for technical indication, which we haven't talked about, a breakout in MACDs. Now, as I also said, there's always a blurring. Maybe you're looking at a chart and you go, man, this thing's near support. And you look over at level 2 and you see the bid building up and the prints turning green and you hit the buy button. Yeah, and you go, oh, well, this is a momenta swing or a swing momo, you know, pick a name.
Where did he get the name day trader? Night trader still? Or what?
Oh, gosh. We'll get off the beaten path, but that's a real good question because you guys use that word fairly liberally. What does day trader mean in today's context? Does it conjure up a guy, like I said, who smokes cigarettes and drinks coffee and makes 100 trades a morning? Yeah, pretty much. That's what day traders kind of they don't smell good and they live in the back of the corner of their house, okay, and they lose their money. Is that another connotation of day traders? A day trader, by its connotation right now, should be, I do not take anything overnight. No, there are no night traders. Okay? I close my positions at the end of the trading day. So I sleep well. I don't have any risk. Nothing can hurt me overnight. I'll open a new transaction tomorrow morning. Okay?
You start each day as fresh.
Exactly. So that's the connotation. Now, what is the denotation of day trader? You guys are going to love this. The real term day trader came from when the New York Stock Exchange in the early 1900s, people that were on the floor owned the seats. Okay, people, some of the names you've heard, Carnegie, Rockefeller at the beginning of the century, J.P. Morgan, these guys had permanent seats on the floor, and they traded amongst each other. But pretty soon they got bored with that. So they would invite outsiders to come in for the day. And they had a day pass to allow them onto the stock exchange floor, and they would do transactions. They may not finish them. They may come back a month later and get another day pass and close the transaction. But they were called day traders because they were allowed in for the day. They were temporary traders. So it's interesting how we have a modern context and where it really came from. Okay, let's look at a quick swing trade. A swing trader would have seen the breakout of the double top on 818 with no gap fill. Alrighty? So by looking at this thing, even intraday over the course of a couple days, we saw our double top here. This should cause the price to go down. So if it broke above on a gap and no fill, remember we talked about gap fill earlier, okay? No fill, does this look like a pretty super strong stock? Sure. So we'd be willing to buy in here somewhere, okay? And off to the races we go. Now, we haven't talked about continuation patterns, but here's a continuation pattern here. And over the course of the next couple days, this thing goes up, and it starts to hit some resistance up in here. You can see where the red candles start to come in. And so we'd be interested in taking some profit off here. Guys, I'd be interested in taking some profit off here. I hate to say this, but I'm Chicken Mike, okay? I see that thing go that vertical. Man, I'm reducing share size all the way along, you know. Start out with a 500 and I end up with 2 shares 3 days later going, should I sell one? You know.
Is that top like a head and shoulders thing?
Well, we don't know yet. I mean, we need another shoulder, don't we? But it could be, this could be a left shoulder here, and this could be the head. Is that what you're saying?
Well, I'm looking at that down spot
Is that
right
the
there.
neck there?
Right to
Here?
the right a little bit.
That's a deck, right?
Right there. Would that be an indication of how far up it's going to go this next time?
Probably not. There may be a measuring object in the flag here, but let's get to those first, okay? No, that's not an inverse head and shoulders, because an inverse head and shoulders is found at the bottom of a downtrend, okay? And a regular head and shoulders is found up an uptrend, and we don't have the other shoulder yet, so we don't know. Okay, so we have seen this breakout of the double top, a technical breakout, no gap fill. We jump on it, and we can find that we find ourselves with a $6 winner. Alrighty? Again, Al's going to say, but Mike, you're picking on these $100 stocks. Well, eBay isn't $100 now. The last one, of course, is position or long-term trading. Now, this is still somewhat of a technical trade, but you're really looking at what? Overall sentiment. How long can something go up? Well, we saw in 2003 that prices across the board went up for the better part of 10 months. Okay? You could have bought in March and just hung on. Already? There was no sharp corrections. There was nothing in there that would really tell you to get out of town. Ready? If we're in positions for weeks to months, we're taking a larger risk. So there darn well better be a good profit in it. We're not shooting for dollar bills now. We're looking for 10s, 20s, and 50s. Huh? Alrighty? Our stop loss is no longer necessarily the 3-to-1 profit margin. It's going to be at major support levels or resistance levels, depending on whether we're long and short. Guys, up until 2000, Microsoft had a major support line at about $77. Alrighty? It was about a 10-year support line. When it went through 77, it could have gone anywhere. And it did. Okay, it just fell and fell and fell and fell. And there's still people out there that own Microsoft at 110, 120 bucks a share. Okay? and now it's trading split adjusted at what, 24, 25 bucks. I hope they're young people. Okay, because they're probably not going to get their money out of it. It's going to take a long, long time before good old Microsoft climbs back up. And it still has to get through that $77 level, because what was support becomes resistance. Okay? Position trading is pretty good for like IRAs, 401ks. Now, you can't short in retirement funds because you're not allowed to borrow money, and you have to borrow to short. Okay? But 401k, you can buy it, hold it for a while, go to cash, let it take a dip, buy it again, go to cash, and repeat as necessary. The big problem with position trading is that you tend to get lazy, guys. You know, you're off playing golf, oh, I'm going to be in this for months. You don't look at the market on a day-to-day basis. It's surprising how many times, you guys know this right now, you get involved with your families, your work, and you look around and you go, wait a minute, the Dow was 10,700, now it's only 10,000. What happened? You know? Oh, things have changed, and they can change very, very quickly. You ready? So you tend not to be as alert. The other thing is it ties up trading capital for long periods. Yes, I might make $10 or $100 on this, but could I do it more often with other things that are moving faster? And that's something in evaluation you're always going to have to think about. Why would you want to sit in a losing position, blow the position out, take what's left over, and put it to work somewhere else and start improving instead of staying stagnant in a losing position? It ruins your capital, but more importantly, it ruins your psychology. It wreaks havoc on you sitting there holding Microsoft at $130. I think Al said it the other day. He said, well, geez, I'd like to be able to get out for something. Sure. I mean, right now you could cash out your 130 Microsoft for $25, but at least you have $25, you go put it in something else, nanotechnology or something that's a high flyer, and start making money. Microsoft isn't going to come off at $25 to $30 for the next year. Okay, so you might as well put the money to work. So what we need to do is, first off, technically look at the sentiment. How are things going, you know? And here we have, what year do we have here? Doesn't show it. Must be 2003. It's going up. Oh, there, it's 2003, yeah. So we can see that even well before the Iraqi war in March, okay, this stock had already started to take off. We had a series of higher lows all the way along. Perhaps we didn't buy it until we got above one of these recent highs. Wouldn't that be a resistance line in through here? So we bought it here. We've already established our uptrend. We buy it somewhere in here, and we just hang on. What's our rule? A close below the line. Well, if we buy this thing for 50, 53 bucks, okay, and we get out for 60, 65 bucks, not bad for a couple of months. We didn't have to do anything. We weren't spending commissions. All we had to do is every day is look and make sure we didn't have a close below our blue line. Okay? So that's position trading. What is the difference between that and investing? Oh, that blue line and the rule. That's the difference. Okay? Investors are, I'm sorry, not very bright as a lot. There's a few good investors out there. I mean, how about Warren Buffett? Does he know what he's doing? Yes. Okay? Does he make mistakes? Absolutely. Okay? But he's a buy and holder, but he's a smart one. He knows what he's about. He knows why he's doing things. I just talked about position trading and swing trading. Okay? And this brings up the comment about overnight holds. And as you guys can clearly see up there, the overnight game is not for the novice. And the simple reason for that is what? You can't control events that happen overnight. You know, the old joke I used to use a couple of years ago was, hey, Hillary could still shoot Bill. You know? Now, I don't know if that make the market go up or go down, but, I mean, you know, you don't know what's going to happen overnight. We could have an earthquake here in California, a hurricane in Florida. We could have Osama bin Forgotten show up with his dirty nuke in the briefcase. There are a lot of things that can happen out there, people, and you can't control it. At midnight, who are you going to sell your Microsoft to? Who are you going to buy your Amgen cover with? You know, there's just nobody. So you're going to have to suffer the slings and arrows of outrageous fortune tomorrow, okay? Now, I say for the novice, I mean at least for the first 6 to 8 months of your trading career. Until you start to build your account, don't be taking risk with your initial capital. I want to see you be day traders, the good definition. You don't have to trade a lot. You can make one trade a day and be flat at the end of the day, okay? This brings on other problems, and we've talked a little bit about them. If you trade every day, your brokerage is going to see you as a pattern day trader and therefore require you to have $25,000 minimum. That's not a good thing. You ready? It's not necessarily bad, but if you don't have it, it's not a good thing. How do we get around it? Well, maybe we can only trade a couple of trades per week if we're going to do intradays. But I want to show you something for a little bit later on and how to start to manage this. And we'll get David all excited here. Okay, so here's our famous stock Academy again. And we'll stick with the numbers. We see in our wisdom, we look at our charts and everything, and we see that we can buy it near support around $30. And we calculate that over the course of 3 days, somewhere around Wednesday, it should reach $35. Okay, that's our plan. So we enter the trade, we buy it close to support, and sure enough, the price goes up and it closes at $31. Should we carry it home overnight? No. Why? Why would you want to carry it? Okay, let's sell it right here and we take the profit off the table. One of 3 scenarios can happen tomorrow. It can gap up, it can gap down, it can open at the same price. Okay? If it gaps up, what's it going to do in the first hour? It's going to have a gap fill of at hopefully 38% or less. Okay? So now we can buy it right here. We're giving up what? 62% of the gap profit, right? The thing comes up and it closes up here at $34. What are we going to do? We're going to carry it home overnight or we're going to sell it? Going to sell it. One of 3 things can happen, okay? Let's say it gaps down and you go, whew, sure glad I have that money in my pocket. But it fills up about 68.1%. We buy it again. Guess what we just made up? The loss over here, okay? And, of course, it gets out at the end of the day on Wednesday or whatever. We're out at 35. Now, people, we spent $10 to get into the trade, and our plan was to spend $10 to get out of the trade. We did it 2 more times. So we got 10 and 10, 10 and 10. Now I'm going to ask you guys a question, and you guys are going to really like this for those of you who are traveling. Where can you get a good night's sleep for 20 bucks? Can't do it at the Radisson, can you? Can't do it at the Comfort Suites, can you? Okay? You're going to sleep well by spending an extra 10 bucks. And what are you going to avoid? Well, what if on this day it does this? Well, I've already got this much. I want it this much. I want it to make the whole 5 bucks. But did I get 4 bucks out of it? Yeah. I got 80% of my game, and I didn't have to make a decision what to do. Will it come back? Should I get out? Should I stay in? Oh my God, I'm back all the way to 30. I still spent the $10. Okay? So by spending an extra couple of commissions at night and the next morning, okay, you get to sleep well and you have your profits protected. Does that make sense? Now, again, guys, this isn't forever. This is until you start to see your way clear. Alrighty? I carry things home overnight. I can afford to take more risk and get more reward. Alrighty? But I can afford it. You can't. You all told me you had limited funds. Number 2, never take home a loser. What do you think it's going to do? Heal itself overnight? You got to spray a little Bactine on it? Oh, give me that Neospore and we'll rub my Cisco here. It'll be better in the morning. Take 2 aspirin, call the doctor, or call me. People, the only time you take home a stock is if it's already a winner and you have some profit in it. That way, if it gaps down, you can still get out with a little bit of profit. If it gaps up, okay, take 50% off, okay? If we're going to take it home, it's got to be closing near its high on the day on strong volume. Alrighty? If there's a large gap, remember, it's going to try to gap fill. Don't let that thing erode. You don't know if it's going to fill 38%. Okay, maybe it's going to fill 100%. So if I'm carrying 500 shares, I'm going to sell 250 if it gaps up. That's a windfall. I expect it to be in this for a couple of days, and it gaps up and I make an extra $1 or $2. I'm not going to say no to that. Okay, obviously, if you're going to take them home overnight, that means you got to get up and check things. Before you go to bed, you got to make sure you check what's going on. And when you first get up, the first thing you want to do, has anything changed? Has there been an assassination attempt in China? How's the Nikkei doing? What's happening with the Hang Seng? Okay, is there any other news that we need to look at? How's it going to affect my stock? And so you have to be extra alert. Now, are you going to sleep as well? No. You're worried before you go to bed, and you're worried when you wake up, okay? So think about these things. The overnight game is not for the novice, okay? I'll let you guys guess who wrote that caption up there. An overnight gap can drain your account faster than a bad marriage, okay? Now look at that chart, people. Here's NXTV. It was trading between $90 and $100 all day long. These people were real happy. There was absolutely no volume. The price shouldn't go anywhere, okay? And somebody right here at the end of the day bought some $90 stuff, 1,000 shares. Wow, tomorrow I may be able to get out at 95 and I'll make myself 5,000 bucks. That was their last thought before they put their head in the pillow. When they woke up in the morning, they found that they had a $40,000 loser. Okay? $40,000 just because you went to sleep. Ready? Do you guys see much of a gap fill here? Do you think this thing recovered? How many people have ever heard the term dead cat bounce? Okay? Trust me, cats don't bounce when they're dead. Don't ask me how I know, but just trust me, okay? Look at the volume. Okay? This is panic selling. By the way, NXTV is trading somewhere around $3.50 now. It never came back. There are still people owning this stock at 90, 95, and 100. Okay? Still hoping that it'll come back someday. Now, as long as we're talking about styles, I want to go into a little bit more. Again, holding something overnight is something you're going to do 6 months, a year from now. You won't be here a year from now, so I got to tell you some of these things now. Okay? The other way we tend to make money is by multiple positions. And we talked a little bit about this earlier. I said you want to be able to go out and find the lead dog and the first 2 lieutenants in a sector. Huh? So what do you want to do? You want to put all your money, you want to buy 1,000 shares of Microsoft, or would you rather go out and buy 300 shares of Microsoft, 300 shares of PeopleSoft, 300 shares of Quest software? Okay? If you think that the software sector is going up, let's spread out and find out which one is the lead dog. After the first 45 minutes or an hour of the trade, you look down and you go, look, PeopleSoft is running at 4.5%, Microsoft is at 2%, and Quest is running there at 1%. Take the profit off the table from Quest, you're up 1%. Okay? Add the money to PeopleSoft. It's running hot, straight, and normal. Watch the 2 of them. Now you got PeopleSoft and Microsoft. Microsoft isn't catching up, close Microsoft and add to PeopleSoft. People, the way you make money is by loading the boat, loading the bus when it's in your favor. You never add to losers. You try to add always to winners. I automatically scale in. I look at a trade and I will go in there and I'll buy 200 shares. As soon as it starts working in my favor, I look around, I see all my trin and tick and everything else is keeping me warm and fuzzy. I buy another 200, and I buy another 200, and I buy another 200. And if it starts to go against me, I blow it all out. I told you I'm chicken. I'm rich, but I'm chicken. Okay, there may be a correlation there. You ready? So the big problem with multiple positions is understanding what a sector is and making sure that you have them. Let me show you this next shot here. Again, this isn't really for the beginners. I want you to trade one stock in one direction at a time, okay? Multiple positions can be extremely difficult to get out of when the market turns sharply against you. Here's a guy, the black ones represent longs, and the red one represents a short. He thinks he's playing a tech sector. Well, AMCC, what is that, Applied Micro Circuits, Biogen, Oracle, and Sun Micro. They're not in the same sector. The closest two are Oracle and Sun Micro, but one is enterprise software and the other one is internet software. Okay? Pardon me? And Sun Micro also makes hardware too. Yeah. Well, they write Java and stuff. How's this guy doing? He's losing in all of them. Long and short, he doesn't know which way it's going. Why will this drive you crazy, long and short? Oh, wait a minute. Green prints are good for longs, but they're bad for shorts. Red prints are good for shorts, but they're bad for longs. What do the white prints mean? Oh, my God. You know, people, you need a whole new set of software. Usually one of the students always asks me, they go, well, Mike, can't we buy long and then sell long and then sell short and buy cover and buy long? Yeah, but I'll tell you, guys, to do that, to flip, means you have to be able to flip your brains over. Everything instantly reverses. Trin is now opposite, and it was already opposite to begin with. So did we straighten out Trin? I don't know. Okay? But you got to start thinking differently when you go the opposite direction. And everything has to be opposite. So you got to be careful. If you're going to use multiple positions, make darn sure that you're in the correct sector, okay, or very, very closely related. That you do have the top dogs in there, and I'm going to show you how to find those. And don't be going long and short at the same time. And it's tough enough, as they say. You know, let's just try one concept at a time here.